Hello and welcome to a special edition of the Daily Brief Show, which we call as the Weekly Brief Show. Here the idea is very simple. We try and recap the best stories from the last week that we covered. By the way, since it is the weekend and a lot of you listeners might have some free time at hand, I wanted to tell you that we have launched 2 new podcasts under the Zerodha Markets banner. Make sure you check it out on YouTube, Spotify, Apple Music or wherever you consume your content. Let's begin with our first story. See, Reliance recently released their quarterly results. Now, I'm sure you already know Reliance is one of India's biggest conglomerates. As we've discussed in some previous episodes, they are just about everywhere, from oil to chemicals to retail, and they are also aggressively entering new categories every single day. And if you remember the discussions from our previous episodes, Reliance is also partnering up with Shein for cheap fast fashion and is also looking to compete against Decathlon. They are also getting into the quick commerce vertical to take on the likes of Zepto, Blinkit, etc. Now, talking about the results, Reliance had a bit of a mixed quarter. See, although the overall revenues went up by about 12% to 2.36 lakh crore rupees, its profits dropped by 20% compared to last quarter. Now, this is largely because of their oil to chemical segment, which makes up almost about half of their revenues. But let's not focus on just the quarterly numbers because the news outlets do quite a good job at that. Instead, let's look at some interesting and long-term trends that have emerged from this quarterly results report by Reliance. First, they are now the biggest retailer in India. They are even bigger than DMart. This quarter, they added about 331 new stores, which brought their total to about 19,000 stores. Second, digital and new commerce now makes up about 18% of their total revenues. JioMart, which is their e-commerce platform, has really taken off as well. It is now available in 180 plus cities. Third, they are even getting into slow commerce. They promise 30 to 60 minute deliveries now. Fourth, Reliance Retail has also been on a shopping spree lately. They have bought stakes in companies like Zivame and Urban Ladder. Fifth, Reliance Retail's growth is fueled by the grocery and electronics segments. On the other hand, fashion and lifestyle segments have not really done too well. However, one thing to note here is that there were many discounts and promotional activities on electronics, while the decline in fashion and lifestyle segment might have been due to a decline in discretionary spending. Now, despite this, Reliance Retail is very focused on refreshing its offerings and launching new store formats. As we discussed in some of the previous episodes as well, there is also a premiumization trend that is playing out. Reliance is also playing along with this premiumization trend by offering premium things like Pret A Manger and Ajio Luxe. Now let's talk about Reliance Jio, which is India's largest telecom operator. First, they added 8 million new subscribers in this quarter, which brought their total to about 480 million people. Second, their average revenue per user or ARPU stayed flat at 181.7 rupees, but they've recently hiked their tariffs by 12 to 25%, so this number might really go up soon. Third, 5G now accounts for 31% of Jio's mobile data traffic. Jio, by the way, has one of the largest 5G subscriber bases globally. Fourth, Jio is planning to invest $10 billion over the next 3 years to roll out 5G across India. Fifth, Jio Fiber is growing very well as well. With over 1.1 million home connections this quarter, the growth is really crazy. Now moving on to the third and final story for the day, we'll talk about how Bajaj Finance is in a bit of a mixed state right now. See, in yesterday's episode, I talked about the rising bad loans in the microfinance sector. In case you missed it, here's a quick recap. Also, IIFL recently put out a report saying that bad loans in the microfinance sector are increasing slightly. States like Tamil Nadu, West Bengal and Madhya Pradesh are seeing more overdue loans. See, credit growth in India after the pandemic has been growing at a stunning pace. Unsecured personal loans, for instance, have been growing at more than 30% as compared to the 10 to 15% before pandemic. This growth in these unsecured personal loans has made RBI really nervous. To slow things down, RBI has increased the risk weightage by 25%. I'll use an example to explain this. Let's say a bank gives a 10,000 rupee unsecured personal loan to a borrower. To do this, the bank had to previously only set aside 10,000 rupees as a buffer against all the defaults. But because of the new rule now, they will have to set aside 125% or 12,500. Now this seems to be working out well for them. The growth of these unsecured loans seems to have slowed down. But why am I talking about all of this, you might be wondering? See, it seems that the microfinance space is not the only one that may be showing signs of early stress. Bajaj Finance is India's largest non-banking lender with a market cap of over 4 lakh crore rupees. Now considering that it is one of the largest lenders, looking at its numbers it may be a good way to understand the trend lines in unsecured lending of India. This quarter's results seem to be okayish for them, but it became a little scary when you look at their non-performing assets or NPAs. Bajaj's bad loans increased from 0.31 in the previous year to 0.38%. Loan collections have also declined across the board. But before I get into the specifics of why this happened or which type of loans got affected, there is one thing we need to understand. See, in banking, loans are classified into different stages based on their credit risk. Credit risk, by the way, is the chance that someone who borrows money might not be able to pay it back. The management said on an earnings call, loan losses and provisions in Q1 were elevated primarily on account of muted collection efficiencies. They further said, given elevated stage 2 assets, loan losses may remain at current levels in Q2 and should start to normalize by Q3. In simple words, here is what they are saying. These stage 2 loans mean loans that are starting to show signs of troubles. The borrowers might be having some issues, but they haven't completely failed to pay back yet. The number of loans in this category seems to be going up. It increased by 865 crores from the previous quarter because people were repaying lesser. Now, all financial institutions set aside some money for situations like this, and Bajaj Finance had done the same, but it seems like that was not enough for them. They had to dip into an additional 105 crore rupees as buffer for loan losses. The net loan losses and provisions after using this buffer amounted to 1685 crore rupees, which is 1.99% of the average outstanding loans. Overall though, Bajaj Finance's rising number of bad loans is a concern for now, but we don't quite know what lies ahead because this is just one quarter. The rise in these bad loans could have been caused by elections, heat waves or just seasonal effects. We will have to wait and watch for now to see if this is just a one-off situation or the beginning of a bad credit cycle. Yesterday we had spoken about how Bajaj Finance saw an increase in the number of bad loans. This quarter seemed to be okay for them, but it became a little scary when you look at their non-performing assets or NPAs. Bajaj's bad loans increased from 0.31% in the previous year to 0.38% this year. Loan collections have also declined across the board. Overall, Bajaj Finance's rising number of bad loans is a concern for now, but we don't quite know what lies ahead because this is just one quarter. The rise in these bad loans could have been caused by elections, heat waves or just seasonal effects. We will just have to wait and watch for now to see if this is just a one-off situation or it is the beginning of a bad credit cycle. But it looks like something is going on with all the lenders. Axis Bank, which is India's third largest private bank, recently released its quarterly earnings and things are not looking quite great for them either. The number of bad loans went up a little for them as well, and this is a worrying sign. Here is what the CFO of Axis Bank, Puneet Sharma, said on an earnings call. I quote,
"The gross slippage ratio for retail, CBG and Bharat banking segments declined year on year. The gross slippage of our wholesale business increased year on year on account of small value accounts. All accounts were less than 100 crores in individual size. This resulted in the bank's gross slippage ratio annualized being 1.97%, increasing 10 basis points YOY. We continue to monitor our retail unsecured portfolio closely and have proactively taken risk actions on growth and underwriting filters as and when required."
The retail segment was the most significantly affected. It contributed to more than 80% of bad loans in this quarter. And the number of bad loans for this quarter stood at around 2%, which was a significant increase from 1.4% in the previous quarter. Now this is just for this quarter, but it is still a little concerning. Here is what the management said about the overall industry. They said, and I quote, "We have seen a spike, a slight increase in unsecured across the industry, primarily driven by high leverage, typically loan stacking that is happening. Now this means that borrowers are taking on too much debt by borrowing from multiple lenders, and this is a big problem because it shows that the consumers are in bad shape. Also, historically speaking, whenever people borrow too much, it does not really end too well." So let's start with the biggest topic for the day, the budget. This year's budget had quite a few interesting changes. Let's go through them briefly one by one. Now please note that this is not going to be a very comprehensive list of all the announcements that were made in the budget. I'm just trying to focus on the main points that might affect individuals like you and I. Now first, the government made some changes to the capital gains tax norms which will affect traders and investors. The short-term capital gains tax has increased from 15% to 20% and the long-term capital gains tax has increased from 10% to 12.5%. But on the other hand, the exemption limit for capital gains has increased from 1 lakh to 1.25 lakhs, which may offset some of the taxes the government ends up collecting here. By the way, this rule has already come into effect from yesterday. So being a long-term investor now might have become slightly less attractive. Also, STT on options has gone up from 0.062% to 0.1% and STT on futures has gone up from 0.0125% to 0.02%. All of this will be applicable from October 1st of this year. Now this means it also becomes costlier for traders and therefore market volumes might reduce significantly. But on a good note though, customs duty on gold and silver has reduced to 6% and on platinum to 6.4%. Now moving on, let's talk about the changes in the income tax. For those of you who've opted for the new tax regime, the tax slabs have been slightly revised this year. According to the revised tax structure, the tax on income up to 3 lakhs is 0, from 3 to 7 lakhs is 5%, 7 to 10 lakhs is 10%, 10 to 12 lakhs is 15%, 12 to 15 lakhs is 20% and above 15 lakhs is 30%. The standard deduction has also increased from 50,000 rupees to 75,000 rupees. Now, according to the finance minister, this move would help an average Indian save as much as 17,500 rupees on taxes every year. What's interesting is that there was no mention of the old regime in the budget speech this time. This also could mean that the government is trying to make the new tax regime more lucrative and trying to phase out the old tax regime slowly. By the way, on this channel today, you'll also see a detailed episode on everything about the taxation from the budget. This will be done by my colleague Bhavya Dua, so make sure you check it out. Now, the next thing we'll talk about from the budget is jobs and employment. See, the government announced that it would provide 1 month's salary support to first-time employees. This means freshers with a salary of less than 1 lakh will get a 1 month salary of up to 15,000 rupees from the government in their PF account. The government also announced a scheme to provide internships to 1 crore youngsters over the next 5 years. These interns will receive a monthly allowance of 5,000 rupees. Moving on, there was also a discussion about corporate taxation. There is some good news for the startup ecosystem here. The angel tax has finally been abolished. I also spoke about why this is important in a previous episode. But in case you missed it, the oversimplified explanation is that startups will no longer have to pay extra taxes when they receive funding from investors. Also, corporate tax on foreign companies has now come down to 35% from the previous 40%. Going ahead, the government also spoke about urban housing. The finance minister announced an investment of 10 lakh crore rupees in housing, and this would help 1 crore urban poor and middle class families. The government also announced a 2.2 lakh crore push to make housing more affordable in the country. Now, there were a lot more discussions around different domains and topics, but since here my focus was to give you a brief overview of what might affect common people like you and I kept this very short. I hope you found this useful. Now, while we are at it, let's dive a little deeper into gold prices as part of our second story. See, gold prices fell by more than 5% on the day of the budget. That's a lot, but this drop was because of a positive news strangely. In the budget, the finance minister announced that customs duty on gold will be reduced from 15% to 6% as I already discussed. Now here's an interesting fact for you. Gold is the second biggest part of India's household assets, and the first, by the way, is real estate. Now the question here is, why is the government being so nice and reducing import duty on gold? See, the last time Indian government increased the custom duty on gold was in 2022 when Russia invaded Ukraine. At that time, crude prices were soaring, and with that, inflation and the rupee were both under pressure. Now, since increased gold imports would have made the situation even worse, the government increased duty to reduce gold imports. But the government is now in a much better situation regarding the current account deficit and inflation, and hence it makes a lot of sense to reduce import duty once again on gold. The second reason is smuggling. See, India imports a lot of gold, and gold contributes to more than 5% of all things imported into our country. This number may be even more if you account for the gold that is smuggled into the country because of higher import duties. Long story short, smugglers do this by over-reporting gold imports, declaring fake exports, and swapping real gold with imitation jewelry through passengers and often bribing officials. In fact, coastal states like Maharashtra, Tamil Nadu and Kerala saw a 60% of gold smuggling cases in 2023. And there is one more reason why this is happening: jobs. See, the jewelry sector provides employment to a good chunk of people in the country. Here is what Sanjay Kumar Agarwal, who's the chairman of the Central Board of Excise and Customs, said on this matter.
Gold is the raw material for gems and jewelry sector, which is very important sector, which provides lot of employment. Something like 50 lakh people are working in that sector. And it is very important sector for exports also. Almost 8% of India's export is from this sector. So that was also one of the reasons to make the legal gold made available to that sector.
Okay.
So it was thought that duty rate can be cut down because and to curb that the gold which was coming through other than legal means and by subterfuge. So it will impact that also.
Now, if you're wondering what this means for the jewelry companies, let me tell you about what the managing director and CEO of Senco Gold Limited said on CNBC. He said,
and in terms of the hit on the inventory valuations, any organized players would ensure that their inventory is hedged. So they would be hedging either on the MCX or they would be hedging by taking gold loan from the banks. There would be some inventory which is prepaid. The duty would be already prepaid to the banks, and which could range between anything between 20-30% for a company to up to 60-70% based on how much of hedging is done by the company. So I think that those which are hedged on the MCX, there is a straight benefit, or I would say risk protection. And to that extent that it is bought from the banks directly, there would be some minimal impact. But the positive way to look at it is that the demand that would really rise up with the festive season coming in. We are towards the end of July. We have August where Rakhi is coming in, and then September, October is the Dhanteras Diwali season. I think that consumers would be much more positive towards buying jewelry as a category, and the wedding season looks to be wonderful.
Now, the other effect of the reduced customs duty is that the demand will suddenly increase. Take a look at this graphic. There's one more thing the CEO of Senco said, by the way. He said,
so the benefit that the consumers would get is around 590 rupees per gram, or 5,90,000 rupees per kilo. So that would be the extended benefit that they would get. Yes, over a period of time, gradually that benefit would pass on to the consumers. Maybe initially the benefit would be of 300 per gram, 350 per gram, and gradually move on to 550, 600 per gram kind of a benefit.
But now, what does import duty reduction mean for companies in the business of lending money in exchange for gold? See, Muthoot Finance is India's largest gold loan provider, and the chairman of the company, George Muthoot, said that gold prices don't really affect the demand for loans because people borrow money when they have a need. They will do it regardless of whether gold prices are high or they are low. It looks like RBI isn't that happy with some of the banks that offer gold loans and gold companies. Why? That is because of how gold loans are given through fintech startups. RBI found some inconsistencies during audits. Because of this, the banks are talking to their fintech partners to fix the issues, and they might pause gold loan disbursements through these startups temporarily in order to make sure everything is done correctly. See, in a previous episode about Reliance bringing back Shein into India, I had spoken about how India had banned Chinese apps. Do you remember the time when the Indian government banned several Chinese apps back in 2020? Look, after the 2020 ban, all Chinese companies needed to follow a rule. They cannot directly enter India or make any investments without the approval of the Indian government. Now it seems like India wants to go back to the pre-COVID relationship with China. The Economist recently published an interesting story about how the India-China relationship might be heading for some sort of normal. See, India and China have had a rocky relationship since their border clash in 2020, but it looks like things are improving now. India still wants China to fix the border issue, but it also needs Chinese technology and investments to boost its industries. In fact, despite all the push for Make in India, it is still a little hard for India to manufacture everything all by themselves. Whether we accept it or not, we will still have to rely on China for certain things. But what has changed? See, first, India has started allowing more Chinese professionals into the country by relaxing the visa norms. Second, sometime back, PM Modi said in an interview that India's relationship with China is important and significant, and he voiced his hope for restoring border stability. Third, both countries are trying to manage border tensions better. Despite cutting down on Chinese imports, India still heavily relies on them, especially in the electronics and machinery segments. Now, if you're wondering how will this change happen, let me explain. See, leaders may refrain from making overly negative statements about each other. There is also a possibility that Indian and Chinese companies will figure out ways to work together because it is in the interest of both of them. From China, India needs technology, goods, etc. And from India, China needs a new market to export all that surplus capacity that they have built up over the last few years. By the way, at the same time, China's own economy seems to be slowing down. Now, the Indian government might also relax more rules to facilitate this cooperation. Many Indian businesses are urging the government to allow more Chinese investments and expertise to help their operations. Now, moving on to the next story, which is also an extension of this previous story, we'll talk about how China is slowly becoming a hoarder of certain goods. See, in one of our previous episodes, which was titled, "Is Geo Ready to be a Grown-Up?" I had spoken about the Chinese economy. A short recap for those of you who missed it: China's economy is facing significant challenges, which indicates a negative outlook. First, China missed its expected 5.1% growth in Q2 of 2024 and achieved only 4.7%. Second, it is relying heavily on government bonds, loans from banks, and giving financial aid to struggling companies. Third, consumer demand has remained stagnant, coupled with high youth unemployment and dramatic decline in home prices, which are the preferred investment for most people in the country. Now, this sounds kind of bad, right? Considering they aren't doing well, in an ideal case, they shouldn't be splurging so much. But that is not the case. China is accumulating large amounts of raw materials and commodities. Opposite to general expectations, China's imports of many basic resources have hit record highs in the last year, and the trend continues with a 6% increase in the first 5 months of the year. But why is China stockpiling, you might be wondering? See, it is definitely not due to increased consumptions, but a precautionary measure. They're worried about any future conflicts they may have with other countries, so they are trying to increase their reserves of critical raw materials, which is to be prepared in case something goes wrong. China has been building up its reserves of grain, petroleum, industrial metals, and defense-related minerals as well. Events like the US-China trade war, COVID-19 disruptions, and the war in Ukraine have made China stockpile even more. Now, here are some interesting numbers and tidbits about China's imports. Now, China heavily relies on imports. In fact, it imports 40% of its natural gas and 70% of its crude oil. But wait till you hear the last one. Governments are concerned about future shortages of critical minerals needed for energy and technology, and China decided to buy them just when they became cheap. So much so that 97% of its cobalt comes from imports now. Also, China accounts for approximately 60% of global soybean imports, and it has purchased more than half of all US soybean exports in the last 5 years. Less than 2/3 of the food consumed in China is produced domestically, and the rest is all imported. And now if you're wondering where China is getting the money to do all this, see, China is using up all its massive savings to pay up for all this stockpiling. Also, China's government prioritizes strategic reserves as part of its national security and economic planning, which ensures sufficient funds are allocated. We'll talk about how India is building an Aadhaar for agriculture. See, in the recent budget, the finance minister announced something called the Digital Public Infrastructure, or DPI, for agriculture. The government's aim here is to bring more than 6 crore farmers into the country's formal land registry system. Now, as you would imagine, this is a huge task. Therefore, the government plans on executing this with the help of something called the AgriStack. Now, simply put, AgriStack is a detailed digital database for farmers. Think of it like Aadhaar, but specifically for farmers. It'll be a massive digital repository with everything one would want to know about a farmer, including their identity, land records, crop details, income, insurance, loans, and even their revenue history. Now, the advantage for the government is that not all this data will have to be built from scratch. The government plans to use APIs to source this data from various other government sources, and they even plan to use satellite data from ISRO to get a detailed view of crops which are sown across the country during different seasons. Now, in case you're wondering if this complicated exercise is even worth it, I'll tell you why this is such a big deal. First, it eliminates all duplicate information related to agriculture. Currently, different government departments have their own databases, and this leads to duplication and sometimes even conflicting data. With this AgriStack, there will be less paperwork for farmers and more consistent information for policymakers to take better decisions. Second, AgriStack will provide easy access to information for both the government and the farmers through one single platform. Third, with real-time data on crop production, supply chain players like food processors and distributions can plan their operations more efficiently. This will help streamline many other systems and processes which are currently very haywire. Fourth, AgriStack will also be able to integrate market price information with crop data. This can help farmers make more informed decisions about where and when to sell their produce. Fifth, with comprehensive data available, policymakers can design more targeted and effective agricultural schemes. Basically, information gets passed on faster and therefore problems can be resolved sooner as well. Sixth, banks and insurance companies can use the data in AgriStack to assess the credit worthiness of farmers more accurately. Now, this can speed up loan approvals and insurance claims for these farmers. But it is important to note here that while more and better data is good, AgriStack can only be successful if the government and the private sector work to relieve all the underlying structural issues that plague the agricultural sector. Now, all of this sounds great, but all said and done, there are a couple of really tall challenges that the government will face here. First is that many land records are outdated or incomplete in India. Second is that the government will need a very complicated system to manage property disputes while digitizing so much of data. And third, not everything can be solved by technology. See, while things like AgriStack will help, the challenges that plague Indian agricultural are actually beyond technology. Things like outdated techniques, lack of access to formal credit, social cultural barriers, etc. are still important to solve. AgriStack can definitely solve some of these issues, but not all. And the effectiveness of AgriStack will only be seen when the government successfully implements it across the entire country. Well, that's all the news I have for you today. I hope you found value in this. I'll see you in tomorrow's episode. Take care and goodbye.